US stocks swept up in a global market sell-off as traders ramp up rate cut bets. Welcome to Market Insight. I'm Peter Devlin. Wall Street plunged on the first day of trading for the week. Disappointing data last week rippled through global markets, prompting fears of the US tipping into recession. Investors are worried that the Federal Reserve has moved too slowly and will need to play catch-up in cutting rates. The VIX index, often referred to as Wall Street's fear index, is set for its biggest one-day rise on record. But are markets getting ahead of themselves? Joining me now to talk about all that is Lauren Saidel-Baker, economist at ITR Economics. Welcome, Lauren. So starting off with the data today, the ISM Services Index expanded from a four-year low today. Is the economic panic real, or is the US economy heading towards a crash landing?
Despite the equity market sell-off, the U.S. economy is not fundamentally broken. So we have been expecting a bit of cooling, of slowing growth trend for quite some time now to really occur throughout 2024. I think that's what we're starting to see. So a lot of these leading indicators are already showing signs of recovery to come in 2025. The pace of that growth is not going to light the world on fire, but it is already established in the leading indicators. That said, the slowdown is never fun for anyone, so we will see more market reactions like this.
So with the market reaction in mind, the next Fed gathering is over 6 weeks away. Wagers on the possibility of an emergency cut have emerged. Do you think this is a possibility?
So there was a lot of concern when those jobs numbers came out on Friday that the Fed has in fact waited too long. I think the signaling at the Fed meeting last Wednesday was very clear that we should expect that first cut to come during the September meeting. I don't think an emergency rate cut is completely off the table, but that is a rather remote possibility. The Fed does not respond to market turmoil. They're looking at these fundamentals, and stock prices have never been a leg of their dual mandate. So I think they're waiting to see. They will not give us a knee-jerk reaction. But this jobs number is, again, another leg in the stool of this cooling from a red-hot level that we've seen in the labor market recently. We did need to see some more movement in this direction for them to be comfortable cutting rates.
So in that long wait to September, is it time to seriously consider the possibility of a 50 basis point cut?
I don't think 50 basis points is off the table. I would be surprised if the Fed goes 50 basis points in September. 25 is looking much more likely. Again, we see the futures market pricing in huge swings to one side and the other. They have been wrong much more than they've been right so far this year. So I don't think we should buy into the panic, into the knee-jerk reaction coming into the pricing today that we'll see an emergency rate cut or that we will see 50 basis points. Again, the U.S. economy is still on a relatively stable base, just not seeing the kind of growth we have in recent years.
Some not as optimistic as you, though, Lauren. We saw an unwinding of the once hot AI trade going on. Magnificent Seven getting a hit as well today. So are shares of chipmakers and tech vulnerable going forward?
I think these shares are vulnerable. I think, again, a lot of it stems from where we've come from, which is huge investment in this space, really, a lot of excitement over the space. So if anything, my question would be, did we see that peak a little bit too high that maybe wasn't so fundamentally justified? A little bit of cooling, again, we'll see it in those types of stocks, but there is still a huge demand for chips makers, for electronics components makers, to see that re-onshoring back to the United States. So any domestic production does have that need, right? We see a huge amount of foreign direct investment in this space, as well as the government support for the sector. So I don't think the bottom is falling out, but we, again, do see a market reaction to these short-term dislocations.
So now just turning to the week ahead now, and earnings continue. We hear from industrial bellwethers as well as media giants. So what is corporate America telling us about the state of the consumer as well as manufacturing?
We'll be watching the consumer very closely for any cracks to form. Again, we're seeing directional deterioration, but keep in mind just how strong our consumer has been in recent years, really benefiting from that COVID era stimulus money, very high savings levels. Again, the tight jobs market has been keeping wages rising at a higher than average pace. So to see things cooling off should be expected to some degree, some amount of normalization in the consumer, but we are not over-levered as we have been in the past. We don't see a lot of the real issues forming for the consumer. Manufacturing sector, that's where we have already seen a little bit more cooling, a plateau generally in the industrial economy here in the United States. So I think the rest of this year, slowing growth will be the name of the game for the industrial sector, for the manufacturing sector, even plateau with perhaps a slight downward bias this year. But again, recovery signs are forming in the leading indicators for 2025.
Lauren Saidel-Baker at ITR Economics, thank you very much for your thoughts. That is your market insight. You can watch more videos on Reuters.com.